You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome along. We're jumping straight into what's really moving the needle in crypto and DeFi right now, using the latest analyses you've shared. The goal today, to sift through the updates, understand the market shifts, look at some cool new innovations, but also face some pretty sharp critiques and track regulatory moves. Basically giving you the key takeaways. Let's get into it. So first up, this institutional momentum seems pretty real. Bernstein's findings on Ethereum Treasury companies holding nearly 1% of all ETH. That sounds significant.
Oh, it is. It's not just pocket change. We're talking about corporations actively seeking those staking yields, maybe 3-5% a year. That's a real draw.
Right. What does that signal, though, beyond just the money?
Well, I think it signals a growing comfort level, a kind of de-risking, almost a legitimization from more traditional finance players. They're moving past just speculation.
Towards strategic allocation, maybe.
Exactly, strategic allocation. But of course, they still have to deal with the practicalities, liquidity, smart contract risks, all that. It's not risk-free.
Makes sense. And it's not just Ethereum, is it? We're seeing big Bitcoin buys, too. MetaPlanet, Strategy. They're really stacking sats.
Yeah, MetaPlanet adding another, 780 Bitcoin? And Strategy raising billions specifically for BTC. Even Tron Inc. is looking to raise $1 billion for its own token.
So the push is broad. And speaking of institutional grade stuff, look at Coinbase derivatives, their new U.S. perpetuals. Quite the debut, right?
Absolutely. Over $1.3 billion in notional volume, 2.4 million contracts traded in week one. That's serious demand.
Yeah.
It shows, frankly, that there's a real appetite for these more sophisticated tools within a regulated space. The infrastructure is maturing.
Okay, shifting gears slightly from the big institutions to maybe more user-focused innovation. MetaMask Mobile has this new Stablecoin Earn.
Ah, yes, the Aave integration. That's interesting.
Right. Deposit USDC, USDT, DAI, earn yield directly via A. And the key things seem to be no extra fees, no lockups, you keep custody, and no KYC needed.
That's the crucial part. Lowering the barrier to entry like that, it makes DeFi yield accessible to potentially millions more users. People who maybe aren't crypto wizards.
Just normal people wanting to earn on their stable coins.
Exactly. It's about making it usable while keeping that self-custody principle. That's powerful.
And speaking of empowering users, or maybe creators this time, this idea of a new economic stack using on-chain primitives.
Yes. Things like tips, collectibles, even content coins, basically pairing media directly with an ERC20 token on the blockchain.
Like that Farcaster example, where 90% of the auction money for a one-of-one collectible goes straight to the creator.
Precisely. It flips the model. Instead of the platform taking the lion's share, the value flows directly. It's about programmability, interoperability. Creators can define their own rules.
Giving them real ownership and control. It sounds revolutionary, but not everyone's sold on everything happening on chain, right?
You're heading towards the Solana debate.
Yeah. Solana co-founder Anatoly Yakovenko calling meme coins and some NFTs digital slop.
Yeah.
Pretty strong words.
Very strong, especially contrasted with someone like Jesse Pollack from Base, who argues, content does have intrinsic worth. It's a real tension.
Particularly when you see data showing meme coins drove, 62% of Solana dApp revenue in June and $1.6 billion in the first half of 2025.
Right, which leads directly into this concept people are calling Solana's crime gap.
Explain that a bit.
Well, the argument is that some of the activity, the volume, isn't purely organic. It might be inflated by things like bundled tokens, maybe insider trading, liquidity that's kind of engineered.
So it looks busy, but maybe it's not all healthy, sustainable activity.
That's the concern, that it could mask underlying network health issues and potentially lead to problems down the line. It really forces the question, how do we tell real innovation apart from just, speculative froth?
That is the question. Which brings us nicely to regulation. We are seeing some movement there, aren't we? Attempts to clarify things.
We are. Things like trying to repeal that IRS DeFi broker rule, the Genius Act proposal, the Digital Asset Market Clarity Act, even talk of an SEC innovation exemption.
So the goal is clearer rules.
Hopefully. Clear standards that protect consumers but don't kill innovation. There seems to be a growing acknowledgement that DeFi, with its self-custody, needs a different approach, not just forcing old rules onto new tech.
A pragmatic approach.
Exactly. Which, by the way, highlights why things like Aave DAO managing its treasury so carefully cutting emissions, building cash reserves is so important. It shows sustainability.
Right, building resilience from within the protocol itself.
Okay, wow. We've covered a lot from institutional buy-in and creator tools to some pretty pointed critiques and the slow march of regulation. It's definitely a fast-moving space. It really is. And maybe that leaves us with a final thought for you, the listener, to chew on. As all this continues to unfold at lightning speed, how do we as participants, observers, builders consistently get better at telling the difference? The difference between genuine, sustainable innovation that creates real value and the purely speculative waves that might just wash away.
A really important question to keep asking. Thank you for joining us today. Keep digging, keep questioning, and we'll catch you on the next Vocal Technologist Update.
Spoken Tech for your ears.